Lululemon posted first quarter revenue of $2.47 billion on Thursday, ahead of the $2.44 billion that analysts had forecast. Same-store sales grew 1%, beating a consensus estimate that had called for a slight decline. Adjusted earnings per share of $1.69 landed exactly in line with expectations. For a Canadian athletic apparel brand that spent much of the past 2 years managing a slowdown in North American premium spending, those numbers told a stabilization story. Canadian analyst sentiment broadly confirmed that picture. On the same day, 35% of the 26 TSX analyst updates logged by the Globe and Mail were target price increases, with Dollarama and Groupe Dynamite both receiving raised outlooks, a backdrop that said consumer spending remained defensible. Into that context, Lululemon's first quarter results read as confirmation. The quarter itself was not the event. The event was in the same press release. Lululemon cut full-year adjusted earnings per share guidance to a range of $10.95 to $11.15, down from the prior range of $12.10 to $12.30. At the midpoints, that is a drop of roughly $1.15, approximately 10%, announced simultaneously with results that beat first quarter estimates. Full-year revenue guidance was trimmed as well, to $11 billion to $11.15 billion, from the prior range of $11.35 to $11.5 billion. The second quarter read was sharper. Lululemon guided second quarter adjusted earnings per share to a midpoint of $1.79, against a street estimate of $2.69. A 34% shortfall on the immediate forward quarter. Shares declined more than 11% in after-hours trading. The unstated premise that consensus had been carrying into the print was that first quarter resilience was a leading indicator, that a company maintaining positive same-store sales growth in a difficult environment had found a floor. The guidance cut dismantled that premise. A beat that arrives alongside a 10% earnings reduction is not evidence of stabilization. It is evidence that what was visible in Q1 was not visible in Q2 and beyond. The capital that moved out after hours was not repricing the quarter that just closed. It was repricing the assumption that the quarter's output was representative of what followed. Incoming Chief Executive Heidi O'Neill takes over on September 8th, and the guidance reset she inherits resets the bar in both directions. On the constructive side, a 10% earnings cut published ahead of a leadership transition is a recognizable pattern, conservative rebasing that allows a new team to rebuild credibility against a lower benchmark, rather than inherit stretched expectations. On the other side, the magnitude of the Q2 EPS gap, midpoint guidance of $1.79 against street expectations of $2.69, is too large to read as conservatism alone. That 34% shortfall on the immediate forward quarter says something is moving in the business that Q1's same-store sales growth did not yet capture. Interim co-CEO and CFO Megan Frank described the company as navigating headwinds and taking additional actions to reposition. The headwinds were not named specifically, which is the variable that O'Neill's first full quarter, the quarter ending roughly November, will price. If Q3 results arrive and the $11 billion full-year revenue target appears intact, the September transition reads as the clearing event. If the full-year guidance is revised again before O'Neill's first quarter closes, the cut today will look like the first move in a longer reset. The verification point is not the CEO start date. It is whether the revenue trajectory in Q2 confirms that the 10% earnings cut was a one-time rebasing or a leading indicator of further compression. For Canadian investors watching TSX consumer names, the Lululemon session offers a precise read on where the market's patience currently sits. A company can beat Q1 and still trade 11% lower in the same session if the guidance tells a different story than the quarter did. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.